Assalamualaikum and hello everyone. Welcome back to my presentation on intra-group sale of depreciable asset, which is an intercompany transaction. And in this presentation, I'm going to show you an illustration or the application example of this intra-group sale of depreciable asset with the focus on depreciation method straight line. Okay, so if you can still recall, when there was an intra-group sale of depreciable non-current asset, there will be two parties. Either the seller is the subsidiary or the buyer is the subsidiary, or sometimes the seller would be the parent or the buyer could also be the parent. So these will give rise to those selling parties or the seller to charge some profit out of that intercompany sale of asset, and therefore these profits shouldn't be realized and it has to be removed or being eliminated in the preparation of the consolidated financial statement. Because the asset is being depreciated, not only that the unrealized profit may have to be eliminated or must be eliminated, but those depreciation due to the unrealized profit should also be adjusted, and the over provision of depreciation due to the unrealized profits may also needs to be excluded, or may also need to be reduced. So the over provision will have to be also adjusted. So this example will illustrate that area of having to do the adjustment for both unrealized profit as well as the over provision adjustment. And I have with me this example of Haiku and Shoto, where Haiku and Shoto, if you can see here, you have the financial statement or statement of financial position of Haiku and Shoto as at 31st of December, year 3. This is going to be the current financial year end. Okay, this is the current financial year end of the company, and that is also known as reporting dates. So these are the information given. The equipment information is given at the carrying value, so you have no information on accumulated depreciation. You also have no information on the cost. So no problem, because you have the equipment at carrying value. And then for the plant and machinery, you have both information on cost and the accumulated depreciation. And if you look at the ordinary shares, this is just information to let you calculate what are the amount of shares being acquired, and these are the retained earnings as at the reporting date. And if you look at the information, the first one here is the information on the pre-acquisition reserve available on the date of acquisition, 1st of January, year 1. So this is not so much of our focus. Our focus will be on B and C. So to look at that, what you need to do is, and let me just zoom that for you. The first thing to do is to look at when is the date of disposal. So if you look at this information, you're informed that on 1st of January, year 3, I put there DOD, date of disposal, high Q. So high Q here is the parent. So what you need to understand here is that the seller here is the parent company, right? And they are the one that sold equipment. So what was sold off is that equipment is being sold off to the subsidiary. Subsidiary here is Shoto. So Shoto is the subsidiary, Haiku is the parent. So Shoto is the buyer and Haiku is the seller. Shoto is the buyer. So the buyer versus seller. So the parent company is the seller. Here the subsidiary is the buyer. So the parent companies in its retained profits would have charged some profit from the sale. If you can see here, this equipment that was sold off to the parent company, the selling price was 50,000. And you can see that the information given there on the date of disposal. And the equipment was bought on 1st of January at a cost of 40,000, and you need to find out what is the carrying value on the date of disposal. Of course, it's not 40, and you will surely see there is a profit, and this is the profit that we need to go and remove the profit here. So in the parent company, what you need to do is we need to go and check the selling price, and what is more important is looking at what is the unrealized profit that we need to go and eliminate during consolidation. At the same time, we also need to go and adjust for the over provision of depreciation. This will be adjusted in the books of the seller. Here the seller is parent. But the depreciation that would be adjusted is the depreciation of the buyer. Okay, for the buyer, they will provide depreciation, will be provided, it will be provided based on the price that were purchased, that was 50,000. So depreciation that was purchased, provided based on the price that were purchased is slightly higher than the depreciation that has been provided by the seller, which is based on cost. Here is because depreciation is provided based on 10% per annum on cost, which is using straight line method. So the depreciation that have been provided might have been over, there will be a cost of over provision, and this is the one that need to be adjusted. So the depreciation of the buyer will need to be adjusted. And where do you adjust? In the seller. So there are two things that you need to adjust. One is the unrealized profit before you can do your consolidation. Second one is the over provision, and that will be done in the retained profit of the seller. That was the first thing. We will be doing that. The next one is the second situation here. So in this second situation, which is in C, I'm using purple. The date of disposal is year 2, beginning of year 2. So this is the date of disposal. So what you need to understand is that in our case, the seller is now the subsidiary. The buyer is the parent. How do I know a subsidiary? So Shoto is the subsidiary, High Q is the parent, and subsidiary is the seller here, and parent is the buyer. So to the seller will have to make adjustment, as I said. One is for the unrealized profit. Another one is to adjust for the depreciation. So it has to be adjusted by the seller. So depreciation. So depreciation that will be adjusted is because it has been over provided. By whom? By the buyer. Here is the buyer. So you need to go and find out first what are the amount of depreciation that were over provided. And in this question, if you can see, you have been given the carrying value to be 60,000, right? 60,000, where the selling price was 60,000. The carrying value was 60,000, but the selling price was 80,000. So in the case here, selling price was 80. The carrying value on the date of disposal, which is on the date of disposal, 1st of January year 2, it was 60 given. So there was a profit that has to be adjusted. The unrealized profit here is 20,000. So this is what we need to adjust by removing it from the retained profit of the seller. This figure 20,000, and we need to go and find out what are the depreciation based on this unrealized profit information. Okay, so you are asked to prepare the relevant consolidation journal entries and also some schedule of the retained profits. But the most important thing is that the impact of this consolidation adjustment in the consolidated statement of financial position. We cannot straight away do this without doing the relevant workings. So let us look at how do we go about doing the workings. Okay. So now we will focus on the workings and doing the question. Okay, let us just do the one related to information B first. Information B. Information B is about equipment. So we have already identified that the seller is the holding company. Remember, the buyer is the subsidiary. So the selling price, as I've mentioned earlier, it was 50,000. So I put the 50,000 there. And it has to be compared with the carrying value on the date of disposal. So on the date of disposal here is on 1st of January year 2. Sorry, 1st of January year 3. So it was purchased on 1st of January year 3. Right, that was the date of purchase, 1st of January. Date of purchase is 1st of January year 3. So you have to find out that, to do that, carrying value, take the cost. Cost is the cost on the date of purchase. It was purchased 1st of January year 2. 1 year after you have purchased, you dispose of. And the accumulated depreciation here is the accumulated depreciation from the date of acquisition or the date of purchase of the asset, 1st of January year 2 up till 31st of December year 2, which is for 1 year after it has been purchased. It was disposed on 1st of January year 3, so for 1 year. So the accumulated depreciation was only 4,000. So if you want to find out what is the carrying value, take the cost minus the accumulated depreciation for just only a year. So you have 36,000 carrying value, and there you have the unrealized profit that is charged or has to be removed by the seller of 14,000. So that unrealized profit, similar to the unrealized profit on intercompany sale of inventories as well, it must be removed. But this one is on sale of equipment, removed by the seller. So the seller is holding company. We will remove the retained profit of the seller, which is the consolidated or group retained profit, 14,000, and it will be credited against the asset that will be disposed, which is the equipment. The equipment is available at carrying value. So when you do this 14,000 will impact your schedule to go and compute the group reserve, which is the group retained profit. So when you go and debit, that will need you to go and reduce to your schedule. So I put there SCH stands for schedule, and that minus sign here is for you to go and reduce. And the equipment, you will need to go and make adjustment in your you need to make adjustment in the consolidated statement of financial position itself, right? You need to go and make adjustment there. But this one is the one that you need to do later. Now we go and work out for the depreciation adjustment. As you can see here, it was disposed of on 1st of January year 3. So from 1st of January year 3 up till the current financial year and 31st of December year 3, that was for 2 years. So you need to go and adjust depreciation for 2 years, because for Shoto, the buyer, that is the subsidiary, they will be depreciating since the date of purchase to them is 1st of January year 3. For that period, for 1 year period, they will be depreciating at 5,000. High Q has been depreciating it at 40,000, which is on cost. This is on selling price, but this is on cost. So there will be a difference in the depreciation. To the point of view of the group is to the point of view of the seller. So the seller here is High Q. So group will be depreciating at 4,000. However, the buyer is depreciating it at 5,000, and therefore there was an over provision of 1,000. And that over provision of 1,000 is the one that need to be adjusted in the seller's retained profit for the purpose of group consolidation, that is to go and eliminate that over provision of depreciation. So that depreciation that was been over provided, which is a difference in these two depreciation, that was 1,000. So you need to go and reduce the depreciation that has been over provided. To reduce means to go and reduce the expenses. So to reduce the expenses in the consolidated retained profit or the group retained profit, which is the one of the seller, 1,000. And since that also affect accumulated depreciation, so you need to also adjust the accumulated depreciation by reducing it. You cannot go and reduce the accumulated depreciation account because there is none. What you can do is go and reduce the equipment, yeah, by reducing the equipment, and therefore the amount that would be reduced would be 1,000. So you are actually reducing the accumulated depreciation because it has been over provided. So you will credit the retained profit to reduce the over provision of depreciation 1,000, and that has to be adjusted by adding it back to the equipment, which is the non-current asset. Go and add back, because add by when you go and debit, that means you are adding back the item. Okay, here you are going to go and add to the schedule. The next one, so then you can go and put that in the schedule. I'm not going to do it now. I'm going to do it after I finish my C. Okay, part C is another disposal that took place in year 2. So before this, it was after a year that it was being disposed. But in this second situation, which is part C, where depreciation is using straight line method, remaining useful life, the seller was the subsidiary, the buyer was the parent. So the disposal date was on 1st of January year 2. So if that was the case, if you can see here, the seller is the subsidiary. The buyer is of course the buyer is the parent company or the holding company. Okay. So the date of acquisition is not given, but you can check that yourself. But the most importantly is that you are given the date of disposal, which is date of disposal. I put here DOD, 1st of January year 2. So the carrying value on the date of disposal, 1st of January year 2, is also given. So here the 80,000 was as at 1st of January year 2, and this 60,000 was also on 1st of January year 2. So you have 80 and 60. And therefore that gives you the profit that has been charged by the seller's subsidiary to be 20,000. And because of that, that needs to be removed, as the consolidated financial statement will not report the intercompany transaction pertaining to the unrealized profit on sale of any asset between group members. And the retained profit of the seller, which is the subsidiary, will have to be adjusted by going and doing the adjustment, right? Which is going to be the same as what you have here. The same thing as well, the non-current asset will also be affected. All right. Next means this is to the plant and machinery of the buyer, the retained profit of the seller. The amount of retained profit to be adjusted is the unrealized profit of 20,000. And here you have the adjustment for depreciation again. But in this example, your adjustment for depreciation will be for 2 years. Why? The date of disposal is 1st of January. And the current financial year end is on 31st of December, year 3, which is on the date you do the consolidation. So that has been for 2 years. So depreciation should be adjusted for 2 years. You take 80,000, which is the selling price, to the seller, right? remember the selling price to the buyer, sorry. You take the selling price to the buyer, 80 to the buyer that was a purchase price, to the seller that is a selling price. So it's 80,000 divided by 5. 5 is the remaining useful life on the date of transaction, times 2 years, because we need to go and remove the depreciation. So we need to first find what are the depreciation charged by the buyer, yeah, and what is the depreciation provided by the seller. And 24,000 should be the depreciation. However, the buyer has been providing it at 32,000, right? How do you get 24? 90,000 divided by 5 times 2 years from the date of disposal till the current financial year end. So high Q, which is the buyer, has been over providing the depreciation by how much? By 8,000. Additional depreciation has been provided by the buyer by how much? By 8,000. That is one way of doing the calculation. Or alternatively, because this is a straight line method, remaining useful life, you can also straight away take this 20,000 and divide it by 5, multiply by 2. Both way will give you the same answer, right? So the adjustment, since you are not just given the accumulated, you are not given the asset at the carrying value, you are given the asset both at the cost and the accumulated depreciation. So the adjustment for the depreciation will not be done directly to the asset account, but it will be adjusted in the accumulated depreciation of machinery. So the depreciation of machinery will be adjusted. How? You go and reduce the depreciation, credit the retained profits of the seller, 8,000, this 8,000, and debit the accumulated depreciation of the buyer, right? And with that, you are going to go and make adjustment just like what you have done earlier. And only that here you're not adjusting the non-current asset, but what you are adjusting is you are adjusting the AD. AD stands for accumulated depreciation. And you need to go and reduce the depreciation, right? That's why it is being deducted. So done with that. So let's see the impact of that. Let me just close this off for you. Okay, we just focus on this. So the impact here is in the schedule. What you can see here, I've done 4 consolidation journal here. So there are 1, 2, 3, 4. And the one related to the equipment is in the retained profit of the seller, high Q, which is the holding company. So you can see the adjustment, consolidation journal entry 1 and 2 is here. And you need to do this first so that you can find out what are the things to be adjusted before you can prepare the consolidated statement of financial position. You need to go and settle the analysis of the financial statement or the analysis of the group reserve and the NCI. However, in this example, I'm just focusing on the impact of the reserve, which is only the retained profit. We're not trying to look at the impact of this in the NCI because that is done to the retained profit. So then for that, both for unrealized profit and over provision of depreciation, since high Q is the seller. For the case of plant and machinery, Shoto, the subsidiary, is the seller. For the second situation C. So therefore, you can see consolidation journal entry E and consolidation journal entry here, number 3 and number 4, which is adjusting the retained profit of the seller, where the seller for the plant and machinery is Shoto, the seller for equipment is high Q. And then after you have done that, that will have impact here in the preparation of consolidated financial statement. What you will do is first you are going to just take the items, which is the asset of the parent combined with the asset of the subsidiary, the equipment. And for the adjustment of unrealized profit, when you go and credit the asset, it means that you are actually reducing the equipment. So remember this journal entry here. right? Just journal entry here. When you credit equipment, you are actually reducing the asset. And the depreciation adjustments, it has been debited to the equipment account. Debited. So therefore, that is actually being added. So this is being added. Okay. Then you get the amount. So what you do here is first you combine asset of the parent and the asset of the subsidiary. The next thing is that you eliminate the intercompany transaction. And our focus of this is just to show the impact to the non-current asset. We're not trying to calculate goodwill whatsoever. We're just trying to focus on the impact of this transaction on the non-current asset. Then we move on to plant and machinery. Remember, plant and machinery is not at carrying value, it is at cost. So the adjustment for the unrealized profit will be adjusted in the plant and machinery account. So first you go and add the parent plant and machinery to the subsidiary plant machinery, meaning that you combine. And then the second one is that you eliminate the intercompany transaction, which is the unrealized profit. The unrealized profit of 20,000. For the accumulated depreciation, since accumulated depreciation is given, you are going to adjust the accumulated depreciation not in the equipment account but in the accumulated depreciation account. And this is the adjustment for elimination of intercompany transaction here. First, you need to go and just take the one of the parent plus the one of the subsidiary and deducted with the depreciation that has been over provided. So here you have the carrying value for both. And for the ordinary shares, you will just show the ordinary shares of the parent company only. Why? Because the one of the subsidiary has been eliminated when it was being acquired by the parent. And the group retained profit is the one that you get from the schedule that you prepared earlier. If you have other reserve, you will also be putting the reserve here. And if you have other non-controlling interest information, you may also need to calculate the non-controlling interest information. But our focus here is on the impact of the intercompany sale of non-current depreciable asset. Let me just recap. And also looking at how do we eliminate the unrealized profit on intercompany sale of depreciable asset in the seller's profit, depending on who is the seller, and doing the depreciation adjustment, adopting straight line method, where I make use of percentage on cost and remaining useful life. And that is the impact that you can see in the consolidated statement of financial position. There will be another example that I will be sharing with you in my next video, which will focus on the reducing balance method. Till then, thank you for watching. If you think this is going to benefit others, please do share that. Give it a like if you think the video has helped you a lot, and that will definitely boost me forward to come out with a better and more helpful video for you, the students. Thank you for watching. I'll see you when I will see you. Assalamualaikum and have a nice day ahead.